Hello, my name is Kendra Westerhouse. I am a student at Muskegon Community College, and today I will be presenting to you details on the banks of the United States. Before starting my presentation, it is important to know that there were two national banks in the United States. I will be referring to them as the First Bank and the Second Bank of the United States. When did the two banks exist and what were their purposes? The First Bank of the United States, shown on the left of the screen, opened for business in Philadelphia on December 12, 1791, with a 20-year charter. Branches opened in Boston, New York, Charleston, and Baltimore in 1792, followed by branches in Norfolk, Savannah, Washington, D.C., and New Orleans in the early 1800s. The bank was overseen by a board of 25 directors, with Thomas Willing as the bank's first president. The bank was established primarily to serve as a repository for federal funds and as the government's fiscal agent. It conducted general commercial business and was both well-managed and profitable. However, it gained hostility from entrepreneurs and state banks who argued that it was constraining economic development. These critics, working with agrarian opponents of the bank, succeeded in preventing renewal of the charter in 1811, and the First Bank went out of operation. Soon, however, problems associated with the financing of the War of 1812 led to a revival of interest in a national bank, and in 1816, the Second Bank of the United States, shown on the right of the screen, was established with functions very much like the first. Who were the people who advocated for a national bank, and what were their reasons for doing so? The 1780s saw widespread economic disruption. The new nation's leaders needed to reestablish commerce and industry, repay war debt, restore the value of currency, and lower inflation. Alexander Hamilton, the first Secretary of Treasury under the new Constitution, had ambitious ideas about how to solve some of these problems. He was the first person to propose the creation of a national bank. He argued that such an institution could issue banknotes or currency, provide a safe place to keep public funds, offer banking facilities for commercial transactions, and act as the government's fiscal agent, including collecting the government's tax revenues and paying the government's debts. Hamilton used the Bank of England as his biggest precedent in his report on the national bank and affirmed that its aid to the government had been substantial during and after periods of war. The plan for a national bank was not Hamilton's alone, but he was its strongest partisan and fought the hardest for its adoption. After the First Bank of the United States closed, weakness in the American financial system was once again revealed by the War of 1812. This caused the Bank of the United States to be rechartered into the Second Bank of the United States. Support for the Second Bank came from political figures such as President James Madison and Senator John C. Calhoun, who were concerned with the low credit and financial solvency of the federal government. Support also came from business leaders such as John Jacob Astor, who were concerned with financial chaos of the time. The man furthest left is James Madison, the man in the middle is John Astor, and the man furthest right is John Calhoun. The First and Second Banks of the United States had just as many opposers as it did supporters. Not everyone agreed with Hamilton's plan for a national bank. Thomas Jefferson was afraid that a national bank would create a financial monopoly that might undermine state banks and adopt policies that favored the wealthy over plantation owners and family farmers. Such an institution clashed with Jefferson's vision of the United States as a chiefly agrarian society, not one based on banking, commerce, and industry. Jefferson also argued that the Constitution did not grant the government the authority to establish a national bank. Maclay, Madison, and John Taylor also shuddered at the thought of strengthening the central government with a national bank. Democratic Republicans and Democratic agrarian citizens also believed a national bank would favor an industrialized society. President Andrew Jackson, as well as Jacksonian Democrats, were the primary opposers of the Second Bank of the United States. The picture below shows the two parties that were split over a national bank, and to the right is Thomas Jefferson, and below him is Andrew Jackson. Setting aside good and bad, what were the national bank's formal responsibilities? For 20 years, the First Bank of the United States functioned and flourished not merely as an indispensable engine in the administration of finances, as Hamilton pronounced it, but also as the regulator of the whole American business world. The bank acted as the federal government's fiscal agent. It collected tax revenues, it secured the government's funds, made loans to the government, transferred government deposits through the bank's branch network, and paid the government's bills. The bank also managed the United States Treasury interest payments to European investors. In addition to its activities on behalf of the government, the First Bank of the United States also operated as a commercial bank. This meant it accepted deposits from the public and made loans to private citizens and businesses. Its banknotes, or paper currency, most commonly entered circulation through the loan process. It extended more loans and issued more currency than any other bank in the nation because it was the only institution holding federal government deposits and possessing branches throughout the nation. When it wanted to slow the growth of money and credit, it would present banknotes to banks for collection in gold or silver, thereby reducing the state banks' reserves and putting the brakes on their ability to circulate new banknotes. To speed up the growth of money and credit, the bank would hold on to the state's banknotes, thereby increasing the state bank's reserves, and allowing those banks to issue more banknotes by making loans. To the right, you can see a banknote from the First Bank of the United States. The Second Bank of the United States had many of the same responsibilities, in addition to trying to fix some of the problems caused by the First Bank. The first president of the Second Bank of the United States was Langdon Cheves. Cheves cut back operation by reducing the bank loans from $41 million to $31 million, and he cut the amount of banknotes in circulation, which brought temporary stability to the Second Bank. Under Nicholas Biddle, the bank attempted to regulate state banks by reducing those that had overissued their banknotes. Lastly, the bank discussed economic conditions and attempted to promote the safety of the entire credit system. So, what were the positive and negative aspects of the two banks' actions? There were numerous benefits that both the First and Second Banks of the United States had on society. The bank's notes gave the country a relatively stable national currency, and by managing its lending policies and the flow of funds through its accounts, the bank could alter the supply of money and credit in the economy. Locating the two banks' branches in the nation's port cities also allowed the movement of banknotes around the country to go much more smoothly, and it helped encourage westward expansion as well. Another positive aspect of the banks was their quickness to restrain the overextension of credit, which protected the economy from inflation. Conversely, in periods of panic or deflation, the bank could ease pressure. The banks carried a remarkable amount of liquidity and were still profitable, earning most of its income through substantial loans to both government and private businesses. It helped to end several bank runs by transferring funds to banks in need of temporary liquidity. Lastly, the bank had no suspension of coin payments, no really catastrophic financial panic, and no failure to pay dividends. Among the positives, however, there were flaws in the two institutions as well. The initial public offering provided scrips that acted as a down payment on the purchase of bank stock. When bank scrips went on sale in July 1791, they sold so quickly that many would-be investors were left out, prompting fierce bidding in the secondary market for scrips. Not only this, but the drastic rise and fall in the price of scrips caused alarm in the markets, which led many to blame the First Bank for such rabid speculations. The First Bank had an enormous impact on the economy by flooding the market with loans and banknotes and then sharply reversing the course and calling in many of the loans. Although the added liquidity initially helped push a rising stock market higher, the subsequent drain caused the very first U.S. stock market crash by forcing speculators to sell their stocks. This so-called Panic of 1792, as well as the script bubble, were short-lived. However, they would be remembered for many years by opponents of the bank. Some believed the bank's fatal flaw was the fact that its money would be open to manipulation by the party in power. others were troubled by the fact that 3/4 of the ownership of stock in the first bank was held by foreigners. Opposers also speculated that the banks were concealing profits, hindering the development of state banks, and would help the wealthy businessmen in cities far more than the farmers in the country. Many of these negative aspects of the first and second banks of the United States can be attributed to their inevitable downfall. By 1811, many of those who had opposed the bank in 1791 still opposed it for the same reasons and said that the charter should be allowed to expire. By this point, Alexander Hamilton was dead and his pro-bank Federalist Party was out of power. Furthermore, by 1811, the number of state banks had increased greatly, and those financial institutions feared both competition from a national bank and its power. The first bank's charter expired in 1811. Congress discussed renewing its charter many times before this, but Congress let the matter languish after the House voted against renewal by just one vote in January of 1811. Popular resentment of the second bank led to efforts by several states to restrict the bank's operations, but in McCulloch v. Maryland, the Supreme Court held that the Constitution had granted Congress the implied powers to create a central bank, and that the states could not constrain that power. The developing agrarian populism in the South that condemned wealth began to refer to the second bank as the monster and the enemy of the common people after Andrew Jackson came to power. The picture shows the Democratic cartoon of Jackson fighting the bank monster. Jackson took his electoral victory as a mandate for action against the national bank. He vetoed the renewal of the second bank and also campaigned on the issue. Jackson decided not to wait for the bank's charter to expire, which still had 4 years, and so he appointed Roger B. Taney to Treasury Secretary, who was willing to withdraw U.S. deposits from the second bank of the United States. The money was put into various state-chartered private institutions called pet banks. The bank carried on as best it could until the expiration of its charter in 1836. The affair became known as the Bank War, and Jackson's victory in it effectively kept the regulation of private banks out of the United States government for almost 80 years. Thank you for taking the time to listen to my presentation on the banks of the United States. These are the sources I used to gather my research. I acquired the first article from the Economic History Association, and the second is an American history textbook. The third article is from the Federal Reserve History of the United States. I read the fourth article on the history website, and the fifth article I found on JSTOR. I read the sixth article in the San Jose State University Department of Economics. Both the seventh and eighth articles were written by James Wittaro, which I also acquired from JSTOR.